Hi, you might have heard that the government is buying billions in mortgage bonds, but what does that actually mean for you and your interest rate? When the government, or more specifically, the Federal Reserve, buys mortgage backed securities, it's trying to do one thing and one thing only: lower mortgage rates. Mortgage bonds are where your 30-year fixed mortgage ends up. When demand for those bonds goes up, the return that investors need goes down, and that lowers mortgage rates. So when the Fed buys billions in these bonds, it artificially boosts demand. That pushes rates down, at least temporarily. This is exactly what we saw in 2020. The Fed bought trillions in mortgage bonds and rates dropped to record lows. But here's the catch, because there's always a catch. The moment the Fed stops buying, or worse, starts selling those same bonds, rates often shoot right back up. And this is why rates feel so unpredictable. They're not just tied to inflation or to the economy, they're also being pulled around by what the Fed is doing behind the scenes. So, what should you do? If you're shopping for a home right now, don't try to time the bond market. Instead, just get clarity on your monthly payment and know your break even point if you plan to refinance later. And make sure you're working with a loan officer who actually tracks this stuff, because it can impact your rate by thousands over time.